Well, a straight sale of LP interest, be it as a single interest or as a portfolio deal, is clearly the most common structure still. Then you have a whole variety of deal structures, like a deal where there is a deferred payment. So there's a kind of a seller's financing where the buyer only pays the sellers in installments, getting a leverage again. Then we have deals like GP-led restructurings, where the GP makes an effort to facilitate the solution, a liquidity solution for its LPs. That's certainly the big driver over the last 2 years. Else we have a variety of options that are available to really create win-win situations depending on the sellers and the buyer's needs, like earn-out structures, where the seller is able to retain some of the upside if the performance of the fund is sold or is going well, for example. It's today possible to really have a solution for a fund at any stage of its life. So we have non-traditional buyers like institutional investors that easily could take an early stage fund. If they're all invested already in the fund, they may well be motivated to take on a very early stage fund. The mature fund market has always been there. That was the where it all came from. And then very tail end, you obviously look at much more asset deals where you need to really look at the assets. It's less the GP skills probably then that are important, but also there you have a lot of focus players now that really look at these asset heavy or concentrated portfolios. We have historically more looked at the tail end situations. Analyzing the underlying companies of these tail end portfolios is a bit of a different skill set than what you see for earlier stage deals, where it's really important to know the GPs very well. And I think our strengths are more on the asset side. Straight sales is clearly the biggest market segment by volume, so typical single line or portfolio sales, and that's clearly the bulk of the business still today. Deferred payment is an attractive proposition often for buyers that can get implicit leverage and potentially can pay a higher price and still achieve their target returns, and of course adding risk to this transaction from a buyer's perspective. Earn-out structures are an attractive tool to allow the seller to retain a certain degree of the upside, and hence if the market or the asset that he sold performs well, he has fared quite well with that structure. So that's a useful tool today. Leverage is a more and more used tool by buyers, typically for more diversified portfolio transactions, and clearly allows to achieve the same level of IRRs while still paying a higher price. Of course, also adding risk to the buyer's portfolio. So staple transactions are secondaries where the buyer is asked to commit to the GP's new fund. So they staple two things together, a secondary and a primary investment, and that obviously requires a buyer that has a mandate which is very, very, very long term, or ideally maybe a fund-of-fund company that does primary investments anyway. These deals were to some degree in favor in the 2000s, then after the financial crisis were becoming quite a bit of out of favor, but have returned over the last 3-4 years, and buyers are there now that have the flexibility and use this if the proposition is attractive enough, i.e. the discount is large enough on the secondary side. GP-led restructurings are clearly a major driver of the recent surge in deal activity. Much more GPs are taking a proactive approach and want to create liquidity solutions to their investors. There is a much greater sophistication of intermediaries and service providers around that topic now, and that's clearly a trend that's here to stay. Direct secondaries, of course, were always there. There are now probably more specialized direct secondary buyers, whereas in the past it was more buyout funds that took over certain direct investments from other buyout funds. Now we have a whole set of specialist secondary buyers that buy a whole portfolio of secondary directs.